Thursday. Literally, actually, 4 o'clock, 4:30 GMT is the sort of sweet spot of midsummer, and we haven't even been on holidays yet. So how dare anybody say it's midsummer? It's not midsummer until I have my malt. Anyway, not to be distracted. Markets have opened in Asia this Monday morning after some turbulence last week, up slightly. Let's kick off with our Monday morning quarterback, Omar Najia, Global Head of Derivatives of BB Energy. Omar, markets picking up a little bit of confidence this morning. The outlook for the Iran talks are kind of going wobbly. And one thing I'd welcome your insights on is the narrowing of the spread between Brent and WTI, now under $2 and closing, and what was more or less a $4 spread much of last year.
Well, I mean, so WTI is more of an indication of demand in the US or demand at Cushing, basically. And Brent is more of a quote-unquote international marker. So that's telling you how strong or weak the international markets are or the global oil market is. So the fact that WTI is narrowing, is catching up to Brent, because Brent is higher, but WTI is catching up. It means basically that demand inside the US or Cushing, or however you want to look at it, basically internal demand in the US is moving up, which is a healthy sign for the market. So the title of
what
that
does
is,
that mean? We see increasing amounts of US crude being exported into Asia, being priced off WTI. Is that
same thing? So
issue?
So it's exactly the same thing. So whether you want to characterize that demand for American crude as basically going into US refiners or being exported or whatever it is, it's a good deal. Just to be simple, think about it as two different markers for oil. They should be at the same level, or if the US is really doing really well and ramping up refinery runs, all the rest of it, the US should be higher. So the fact that one is narrowing and there's not such a big divergence between them is that thoughts are aligned in terms of strength going forwards on the oil markets. That's the way I look at it.
Does it impact the? I know that there was a sense that the U.S. crude was getting a foothold into Asia because it ultimately was at a discount to Brent. And I'm wondering, now that is tightening, does that in any way, we've got Murban now launched recently, obviously here, which is not a dissimilar crude to WTI in terms of sweet composition. I'm just wondering, could it impact any of that sort of market access into Asia as it spread tightens?
Well, first of all, I think you have to make a distinction between futures, so WTI Brent, and the physical, which is what you're talking about. So they're basically like, I don't know how to bet, but one's about this size, which is the physical stuff, which is the spot stuff, not the stuff that's termed out.
Right.
And the other one is about, between here and the height of Burj Al Arab, because it's where the money is, where money flow is, all the rest of it. So, it does no good to kind of, compare the two. It's two different kinds of animals. So just the fact that whatever you price off, you can price off two markers, or if you want to include Murban, three. But the fact that they all, for the same grade, move in alignment or move higher is an indication of, or is a bullish indication. If that spread was widening, it would basically be a bearish indication in general.
Let's bring in James McCallum, Executive Chairman of Exergy, Professor of Energy at Strathclyde University in Scotland. James, welcome back to the table. Since we had you on last, the big oil has taken a hit from a number of sides in terms of the sort of energy transition agenda, to the extent where what we had expected to be more of a medium-term issue, i.e. the lack of investment in new capacity, not necessarily going to be an impact in the front month or in the current cycle, 2021, but perhaps 22, 23, now feels like it's becoming slightly accelerated forward by ultimately the lack of return of investment into shale. But this squeeze on the majors is coming earlier than maybe we have all have expected.
I'm not sure it's earlier than I had thought it would come. The rising activism and very public activism that's ongoing now is now quite clearly an issue that the industry recognizes is not going to go away, and it's not going to go away anytime soon. And so what we're actually seeing is, real active response to that. And that active response is not just driven by boardrooms feeling pressured, it's actually driven by significant boardroom changes that are being compelled by shareholders. If you take a look at the article on your digest, which I think is a fascinatingly important article for the listeners to read, which is Big Oil Looks to Cut Production Following Activism. And you take a look across the piece at the sort of like the Exxons, the Shell, the Occidental positions, you see that this is something which is now very much on the front agenda for all of the super majors. I think the reality is that what we are seeing through their actions is that similarly, Sean, this is not something which is going to go away anytime soon. And so the actions which are being taken now, companies cutting production, and that includes Exxon down almost a 25% position from their original targets in 2025, down to about 3.7 million barrels a day in 2025 from their original projected target of 5. Similarly, Shell easing out of production. This is a very, very real transitionary issue, which is very much shaping the way that these companies will go moving forward. Now, the one thing I will say, which I thought was interesting in that article, is that very much against the trend of the European producers, where you see Shell looking to put maybe all of its Permian Basin assets up for sale. You've got Exxon still peddling a position that they will almost double their production targets in the Permian Basin over the coming years. So pulling back from their global target, that means investing in big oil fields around the world, but sending a message, Exxon, that they intend to very much stand by the Permian Basin in the United States.
Frank Kane, senior business columnist at Arab News. If I recall,
Sean.
Frank, the last time we had you on, you were sitting in your palace in Riyadh with the beautiful chandelier backdrop. I see you've returned to slightly more simpler settings.
Yeah, well, they kicked me out, Sean. You know that.
It's like you can't have this chandelier out of here.
No.
Frank, before I would just want to get your follow-ups on your amazing, great interview you did with Daniel Yergin on your show, which we posted on the digest today.
Yeah, thanks for that.
First, I wanted to get your thoughts on the sort of end of round 6, I believe, of the Iran talks yesterday, with the backdrop of the Iranian election. General sentiment not so positive, even though they had been talking a long time. It seems they left all the big issues on the sidelines and never really got to them. Your thoughts on where that is at and the outlook for it?
Well, I think it's no secret that Saudi Arabia doesn't like this proposal, this deal. It has no problem with peace in the region, and it probably has no problem with allowing Iran into some kind of nuclear setup under supervision. But what it does have a problem with is Houthi drones and Iraqi missiles and Syrian missiles flying over the border into Saudi Arabia. And as long as these talks, the JCPOA talks, don't really encompass that exported terrorism aspect of it, they don't see much value in it. However, I mean,
although we did get, just to note that we did get, which with the UAE side yesterday, congratulations, a sort of standard diplomatic kind of acknowledgement of the new president winning the election and so forth. The UAE did reach out and send the offers of congrats.
Well, the UAE does, doesn't it? Because it has a large number of Iranians here, for one thing, and there are still, much closer commercial links between the UAE and Iran than there are between Saudi Arabia and Iran. So it has to protect those, and I guess it's being civil. I guess the Saudis are being rather less civil, maybe more hard-nosed. But I get the feeling from them that they aren't particularly concerned that this is going anywhere soon. That this will not happen quickly. We are still, I don't know, a couple of months away from some sort of JCPOA deal, and we're 6 months or more away from some kind of re-entry of Iran onto global oil markets, within the OPEC framework. So it's not happening anytime soon. They have plenty of time to adjust, and that's where I think they are.
Omar, one of the things that we've been talking about for some time over the sort of recovery of the oil market from a demand side has been the return of aviation. And why we've seen in the US a significant recovery in travel there. We also have the announcement yesterday in the UAE that they're reopening their Terminal 1, which for anybody that knows the Dubai airport is the international non-Emirates terminal. So i.e. they're expecting long haul to recover up to 80% according to the CEO of Dubai Airports over the second half of the year. Your thoughts on that, Omar, and how important at this point is that aviation component of the oil barrel to really get back to the sort of pre-COVID levels?
Okay, so story this morning, US passengers going through security at US airports exceeds 2 million a day for the first time since March 2020, while European air traffic has risen by 1/3, that's 33.3%, in the past month. Okay, so, and I think gasoline demand in the States has already overtaken last year. So all that is rear window kind of view. So right now, what's facing the oil markets is, either some kind of quote unquote COVID variant or this quote unquote Iran deal, neither of which seem extremely likely. In fact, from what I read, and I don't know, the negotiations in Vienna are basically, one of the hurdles is that the Iranians are requiring not only the lifting of sanctions, verification, all this kind of stuff that I talked about before. They're requiring a quote unquote ironclad guarantee that the US cannot walk away from the deal as it did in the past. So again, I think that for the US to agree to lifting all sanctions, waiting for Iran to verify, giving them ironclad guarantees, et cetera, it shows that basically the power, the people holding the cards are the Iranians. And for the US to agree to this is going to be a huge geopolitical event, a massive one. Well,
there's no way they can even technically agree to that, because that's not in the purview of the president, because the Congress obviously has a vote on a treaty, and the president can't even deliver that.
Then it's going to be a long or short.
And of course, the Iranians would be well aware. The Iranians would be aware of that. So it sort of gives you a sense of the outlook for these talks may not be as necessary. I mean, may not get there. Just Omar, quickly on the Fed decision last week, which sort of announced the sort of beginning of the beginning, the talking about talking, but ultimately, in some sense, that the big free money punch bowl might be coming to a close at some point in the not too distant future. Any relevance for the paper oil markets?
No, but I think relevance as to the general kind of, living in a kind of fantasy land and people actually listening. I mean, if the Fed increases interest rates, what happens to all this US debt? How are they going to finance it exactly? So this is the problem with the Fed. The Fed has to basically keep providing liquidity. Otherwise, everything implodes. And the reason everything implodes is because as soon as they start raising rates, you know, the interest on their debt on its own, not just in the US but worldwide, is just going to make everything implode. Let alone people pulling money out of the markets and all the rest of it. So this is the trap. The Fed can't keep giving money. You know, if it keeps liquidity, going, then inflation comes. If it raises interest rates, then everything collapses because basically, they're at zero. Call them, say they're at 0.1%. If they double, that's 0.2. If they triple, quadruple, go up a factor of 10x or 100x, there's, these levels of debt are just not sustainable. So what does the Fed do? So when the Fed says in 2023, we're going to do, 1 or 2 or whatever, I mean, I don't know how that works. I don't know what it is, but they raise 0.1% but I think it's all kind of fluff. I think people know that.
James, your thoughts on that? Because clearly the exit from this phase of obviously ultra easing policy, monetary policy, fiscal policy into the economy standing back on its own 2 feet is an incredibly fragile period, because within it, investors have to plan new capacity. Like you talk about oil on our side, in the sense of, are you going to invest multiple billions of dollars into an uncertain 2, 3, 4 year cycle? Your thoughts on the Fed decision and the exit from the sort of COVID economy to the back to normal?
Yeah, look, I mean, clearly if you read the Fed responses, they're very divided in terms of where this is likely to go. I think it's said that the majority anticipate a couple of interest rate moves in the coming years, and one probably in 2022, but it's by no means a unanimous position. So very divided there. I think the bit that I look at is so back to, if you like, the demand on product, back to the storyline that we were talking about earlier on, the super majors pulling back from production, India negotiating new supply contracts outside of OPEC, and including Russia, who clearly are part of the OPEC discussion. So clearly Russia playing both sides of that fence. But what I found about that interesting was locking into longer term contracts at this kind of price point for India. So what is that saying? Is it saying that they are accepting that this kind of an oil price is probably where it's going to be for some time? I thought that was fascinating. I think there are the 3 areas for me that are at play here are US position in terms of how it maintains the stimulus on the economy to keep pace with Asia. What happens in terms of production returning to the market to meet supply increase, and it's quite clear that demand for product in the West is returning faster than many people thought. And back to this other point, which I thought you raised earlier on, which kind of I'm not sure we spent enough time on, which is what is the political stability looking like in the Middle East? Where is it? We've got a new Israeli prime minister who openly declares he's even further to the right. We've got an Iranian president who, if you like, probably raises the temperature in terms of what's going to happen in their positioning into the talks. So those are the 3 things that are at play, and I think they're pulling in different directions for me. I think you have a
US president who really wants to get on with dealing with China and not be dragged into more turbulence in this region.
Yes, I think that's exactly right. There's some talk that you'll see one of the other pieces that's there, pulling military activity out of the Middle East to favor, if you like, a repositioning in US foreign policy towards Russia and towards China. So, there's contradictory messages all over the place in what's coming out right now. I think we're going to very much have a sort of suck it and see type of view to sort of federal stimulus. Although I guess my leanings would be that that's probably in the rearview mirror rather than ahead of us now. repositioning of foreign policy in general.
I mean, one always has to remember, Frank, don't we, that geopolitics is never that far away, and it sort of lingers
in this part of the world, sure, yeah,
as a fracture. But I wanted to get quickly from you, Frank, the headlines from your interview with Daniel Yergin. I noticed the first question you asked him was, have we witnessed ultimately the end of oil, which kind of is, just being a little bit facetious, but nonetheless, your headlines with him.
Yeah, well, look, he was really interesting. He's one of the great men of oil. The headline that the paper put on it was that Saudi Arabia has, played a great game in rebalancing the oil market, but that's because it's a Saudi newspaper. That's what you'd expect.
And I would have to say, as objective as one can be, it's certainly true, right? I mean,
yeah, for sure, yeah.
And Prince Abdulaziz has delivered in this last 12 months.
And I think that Daniel was being pretty, candid and serious when he agreed with that idea. The other things he said, he had just been to Houston in Texas for a shale conference, and he came back with the very definite view that shale was on its way back, even if it's in a more, disciplined, financially straightened way. It's paying back dividends. It's paying down debt, but it's on the way back in a rather more modest way, not the huge explosive growth of the past. He thinks there is substantially more environmental regulation to come from the Biden government.
What was his general narrative about the squeeze we've seen on the oil majors recently?
Yeah, that they are taking seriously the idea that they have to respond to investors, that they have to pay their financial dues. You mean that kind of squeeze?
Yeah, I mean, the energy transition.
He wasn't too concerned by things like the Exxon, the
activist shareholders putting the board members up,
nor Shell, nor Chevron. And the share prices of those quoted companies, which haven't responded to the increase in the oil price. I guess in the past you would expect them to, wouldn't you? They haven't, because they're doing things like paying down debt, increasing dividend. But at some stage in the future, those share prices will respond, he said. He was also really quite barbed and interesting on the IEA. If you recall their report from a couple of weeks ago, calling for the immediate end, calling for, was it a scenario?
Well, what they said was ultimately, if you want to hit the Paris Climate Accord target of 1.5,
stop it now. Yeah.
I mean, they didn't say do that or you have to do that, but they said, if you want to do this, you got to do that.
He was puzzled, surprised, because just a couple of months ago, the IEA was saying that there wasn't enough investment going into hydrocarbons, and
just last week they called for more supply. But listen,
exactly.
That interview Frank has is posted on the digest today. Recommended half hour. Well, always worth giving Daniel Yergin a few minutes, maybe not 30 minutes, but 10 anyway. Let's get the survey question. And give the room a view where we started this conversation before we ask the panel to give us their thoughts for the week ahead. It's the question of the Brent WTI spread narrowing. Will this spread continue to narrow as it has been towards $1 of a spread in the second half of this year? Because clearly the US recovery is moving faster than everywhere else. Demand is fairly robust, as Omar mentioned, in terms of travel, airline travel, etc. So do we expect this spread to continue to narrow? I think it's something to watch. And then what its ramifications are for US oil exports, which are now up towards 4 million barrels a day. Omar, the week ahead, it's Monday morning, as we said at the beginning of the session, the markets have opened up in Asia, even though equity markets are still being somewhat smothered by the news of the Fed last week, but oil nonetheless has had continued its upward motion. What's your thoughts for the week ahead?
Well, basically no change. And if you look at Shell, there was another very interesting story saying that their losses or unrealized gains, whichever way you want to look at it, for 2021 and 2022 are currently $11 billion. That's because they quote unquote hedged. So I'm afraid shale is going to have not only to deal with, but they don't benefit from rising oil prices until, I don't know, maybe after 2022 sometime. So at the end of the day,
because they're locked into a lower price.
They're locked into a lower price. There's no way. I mean, this is the whole point. The point that, I mean, the point is OPEC Plus can control the market. The reason is they don't have somebody outside that alliance that can come and put substantial amounts of oil on the market. That's what's basically changed. And the reason that's changed is because of shale, and because basically of what we saw with the markets, interest rates, liquidity, all that kind of stuff. So it's not a question of getting more money from investors. It's not a question of paying back whatever it is. It's just not going to happen anytime soon. It really isn't. Maybe in the future at some point, I don't know, but so I think basically markets in general, whether basically the equity markets correct a little bit, and the Fed really saying that they're going to increase interest rates doesn't do a great deal for me, because simply really they can't. So basically it's like a little bit of scaring and ooh, but
Well,
give it a week.
that's a big scaring. I mean, the Fed is the 10,000-pound gorilla. They're not, at least on recent performance of the last, I don't know, decade. They're not in the business, James. Your thoughts on closing comments for the week ahead? They're not in the business of misleading the market. I mean, if anything, they have become addicted to forward guidance and being, fairly consistent with that. But your thoughts, nonetheless, James, in terms of the week ahead, where the market may move. As we say, at least at this window, oil is not falling to the same consequence that equities are after the aftermath of the Fed comments. You're on mute, James. Sorry.
Beg your pardon. I think that's right. I tend to pick up on Omar's comments. I don't see a massive amount of change over the course of the next week. I'm not sure on the comment that Frank made around the if you like, the super majors and responding back to the fall in their share prices, which have been 4 or 5% over the course of the last day. I think that fall is a reaction, if you like, to the growing discontent that exists amongst the shareholders and amongst the public. And I think we all need to get used to that. Omar's point around OPEC being in very strong control of where the oil price goes, I think is increasing. And as more and more majors pull back from production, they're only going to exercise more control over that. I think I'm watching over the next week whether more players, including OPEC players, get into hedging with some long-term supply contracts into Asia, and what that means going forward in terms of oil price. But for me, I think we'll continue to hear the rhetoric out of the Fed around interest rates versus no interest rates, because it's, if you like, it's a sort of a scaring tactic that's there. I think we'll see a closing. So you guess that's where, I voted a closing in terms of WTI to Brent, but I don't see any increase in activity in the US anytime soon in terms of the Permian. In fact, I think it will continue to decrease from where it's actually at. So little change this week, but watching very carefully what's happening in the Middle East and the political dynamic between particularly Israel and Iran.
Frank, let's give you the survey result before the last word. The spread to continue to narrow seems to be an overwhelming point of view in this room, nonetheless. Frank, your thoughts also about, in terms of a regional perspective, Fed going into a tighter cycle, because it's also another outcome of last week has been a strengthening dollar, and what that means for the Gulf region.
Well, the peg is still there, so it goes in lockstep, doesn't it? More or less, it's not very good for oil. A strengthening dollar, is it? I'd be a bit cagey about financial markets, which were quite badly hit in Asia today. I think the Tokyo market was down 4% at one stage or something. will this reverberate around the world today? I don't know. And then towards the end of this week and next week, of course, there's an OPEC Plus meeting on the 1st of July, which, that has to say something. We are now reaching the end of the 3-month period of graduated increases. It has to say something really, or give some indication about where it goes from August onwards. So, that will set the tone for the autumn, or, we would hope it would.
We'll obviously start to hear little pearls of wisdom dropping off the table of the different OPEC plus countries. We had some comment ourselves with Sarah Akbar out of Kuwait at the end of last week saying she would expect an additional 1 million barrels in order to cool markets down. Any signs, any rumors on your side, Frank, from what you're hearing?
I haven't heard a great deal yet, but I
Right.
think 1 million is too much. He is a cautious man. You saw him in that Robin Hood forum in the States last week, the Wall Street Forum, didn't you, Abdulaziz bin Salman? I'm a cautious man. I think just 1 million is too much.
Interesting. Okay, well, let's wrap it up there. It certainly will be, I'm sure the OPEC journalists will be kicking the tires and dripping out pieces of information as to where OPEC goes next, because it probably is one of the bigger factors that could drive this market. It probably, you would expect to trade sideways in the low 70s until we get some clear view of where supply goes in the second half of the year. But let's wrap. Omar, thank you as always. Thank you very much. James, Scotland, and Frank, and may Scotland have a great success in the coming. Scotland are playing? I can't remember now who the last game is against.
Croatia.
Croatia. Okay, that's a big one. They got to get a win there, don't they? They nearly got one the other night.
I think it depends on how you look at that, which lens. I think it was a fair result, probably.
Yeah, probably. If one wants to be objective, but who wants to be objective, right? Frank Kane, with the famous name of Harry Kane, the Irish captain of the English football team. Hopefully he does a little better for himself and his price point so that he can trade to Man United at a good
Sean, don't get me talking about Harry Kane. I'll be on for another 30 minutes. I promise you.
Is that all? I mean, that seems relatively minimal. But anyway, thanks everybody. Have a great week. We'll catch you in the coming days. All the best. Cheers.